Welcome to Tracking Stocks, the channel where we implement proven trading strategies used by the best market technicians, from William O'Neill to Stan Weinstein to Mark Minervini. Here, we focus on what really moves markets: price, volume, and institutional activity. No hype, no speculation, just disciplined analysis built on data, patterns, and principles that have stood the test of time. One of William O'Neill's core principles in How to Make Money in Stocks is the importance of increasing institutional sponsorship. In his CAN-SLIM strategy, the I stands for institutional sponsorship, and it's there for a reason. When large funds and institutions quietly build positions, they leave footprints, and the smart investor pays attention. Here at Tracking Stocks, we measure that sponsorship through 13F filings, quarterly reports that reveal what the big players are buying and selling. When the number of institutions filing ownership reports rises over time, that's a sign of growing conviction, the type of confirmation O'Neill wanted you to look for before a major move. In this video, we'll analyze both 13F growth trends and technical setups for several key names, including Palantir, Google, NVIDIA, and Apple. You'll see what strong sponsorship looks like, what weak sponsorship warns us about, and even a newer stock that's just beginning to attract institutional attention. Let's get started. Palantir. Palantir is the model company for 13F growth. It has seen sustained increases in institutional ownership, both in recent quarters and over the long term. Quarter over quarter, filings are up about 19%. Year over year, nearly 110%. And over the past 2 years, an incredible 188%. What makes Palantir stand out is that this trend didn't slow down during the 2025 correction. Institutions kept adding while most others saw reductions. That kind of steady accumulation, even through market weakness, is exactly what we look for when tracking sponsorship. Palantir's weekly chart shows a long-term uptrend that's been sustained for several years now. After breaking out in May, it formed a new cup with handle starting in August, with a gentle downward drift typical of O'Neill setups. On the daily chart, price recently tested the handle high near 190, briefly pushed above it, but failed to close higher. That leaves us right at the pivot zone around 191. What stands out is the volume contraction near the lows, a classic sign of institutional support. The plan: buy on a clean breakout above 191 with strong volume, ideally 40 to 50% above average. Stop loss, 8% below entry. No volume, no trade. NVIDIA. NVIDIA also shows solid institutional growth, though not nearly as explosive as Palantir's. Quarter over quarter, holdings increased 2.6%. Year over year, roughly 15%. And over 2 years, about 48%. This steady climb in filings confirms continued sponsorship from funds, the type of measured, sustained buying that typically supports a strong long-term leader. NVIDIA's weekly chart shows a long-term prior uptrend with no real correction since its major breakout earlier this year. The stock formed a base with a pivot around 185, broke out cleanly, and rallied up to about 195, before pulling back slightly when the broader market corrected over the last couple of weeks. The structure remains bullish. This looks like a normal, healthy contraction after a strong run. The key now is whether NVIDIA can reclaim and break through 195 again on renewed volume. A close above that level would signal strength returning and could mark the next leg higher. Google. Google has shown slower growth in institutional filings compared to peers like Palantir or NVIDIA. Quarter over quarter, filings rose 1.4%. Year over year, 8.2%, and over 2 years, 24%. This suggests steady but moderate sponsorship, consistent with a mature large-cap leader that still attracts funds but isn't in its early growth phase anymore. Google's weekly chart shows a steady long-term uptrend, though it was slower to rally than some of the other big tech names. When it did start to move, the advance was consistent and supported by rising volume, a strong sign of institutional sponsorship. A key bullish signal came in April, when Google rebounded sharply from its lowest levels, on much higher volume than the prior week's decline. confirming that institutions were stepping in aggressively. Following that rebound, the stock began forming its first major base since the rally began, creating a healthy consolidation before the next move. On the daily chart, there's a downward sloping handle with volume drying up. Exactly the type of quiet action O'Neill looks for before a breakout. The stock has now cleared its pivot near 256, closing around 269. As long as Google can hold above the 260 range and volume builds on strength, it remains a constructive setup in a market-leading name. Adobe. Adobe is the opposite story. Institutional ownership is declining. Quarter over quarter, filings dropped 0.5%. Year over year, negative 4%. And over 2 years, only up 5%. This is a red flag. We want to see rising sponsorship over time, not contraction. Funds have been trimming positions, signaling reduced confidence or rotation out of the name. Adobe's weekly chart is clearly in a long-term downtrend. The stock continues to trade below declining resistance, and every rally attempt has been sold into. This is distribution, not accumulation, the opposite of what we want to see. While value investors might look at this differently, there's no valid buy point on the chart right now. Until Adobe forms a new base and shows clear institutional accumulation, it's a no-trade zone for growth setups. Bath & Body Works. Bath & Body Works is another weak name in terms of sponsorship. Quarter over quarter, growth was 1.6%, but down 8% year over year, and negative 2.5% over 2 years. That's a clear decline in institutional ownership, a major red flag, and not what we want to see when screening for strength. Bath & Body Works has come out of a long-term Stage 4 decline and is now in a Stage 1 consolidation, using Stan Weinstein's framework. The base is still forming, and there's no evidence yet of a transition to Stage 2. The potential breakout zone is around $40, but the stock remains well below that level and could stay in this range for a while. We don't know how long this consolidation will last, so for now, this remains one to avoid until it builds a stronger base and breaks through 40 on strong volume. Adtalem Global Education. Adtalem Global Education shows explosive institutional growth. Quarter over quarter, filings jumped 11%. Year over year, 45%. And over 2 years, 93%. That's a powerful signal. Funds have been consistently adding exposure. The challenge, however, is whether the stock's chart structure can keep up with that sponsorship. Adtalem Global Education is working a third base around the 153 area, with a potential breakout near 155.60. Per William O'Neill, third and especially fourth stage bases carry a higher failure rate, so this setup is higher risk, even though it looks technically sound. Given that late-stage dynamic, I'd prioritize cleaner, earlier stage leaders. If traded, I'd insist on a decisive breakout above 155.60 with strong volume. Use smaller size and keep a tight stop to manage risk. SEALSQ Corporation. SEALSQ is a newer IPO, so its 13F profile looks very different. The total number of filings is still small, but growth has been explosive, up 40% quarter over quarter, up 520% year over year, and up 375% over 2 years. Those huge percentage increases reflect institutions gradually discovering the stock, rather than broad, mature sponsorship. Typical behavior for a recent listing. SEALSQ is still a young stock with limited history. On the weekly chart, it's formed a deep cup pattern, falling from over $10 down to around $2, far deeper than we'd normally like in a healthy base. There's heavy overhead supply between $9 and $10, which will be a major test. The encouraging sign is the sharp rise in weekly volume over the past 3 weeks as the stock rallied. Early evidence of accumulation. We'll need to see a breakout above 10.50 before confirming a new uptrend. For now, this one remains a watch list name that may turn into a buy after it overcomes its overhead supply. Apple. Apple's institutional ownership has remained steady, similar to Google's. Quarter over quarter, growth was flat. Year over year, up 7.6%, and over 2 years, up 21%. That's not explosive, but it's consistent. Apple continues to attract long-term holders and remains a core institutional position, even if it's not expanding as rapidly as newer growth names. Apple's weekly chart shows a long-term uptrend that's been intact since 2020. The stock went through a major correction from December through April, which was deeper than ideal, but it rebounded strongly afterward. The prior high before that correction was around 260, and Apple has now broken out above that level, closing near 268. A positive sign is that the rebound week following the heaviest April sell-off came on higher volume, showing clear institutional support. However, volume hasn't confirmed the recent breakout yet. I'm bullish as long as it can hold above 260, but I'll look for a decisive increase in volume to confirm sustained momentum. Tracking 13F growth isn't about chasing headlines. It's about following the smart money and aligning with institutional momentum before the crowd catches on. As we've seen, the best performing stocks share one trait: rising sponsorship backed by constructive price and volume action. If you found this breakdown helpful, make sure to subscribe to Tracking Stocks. We'll continue covering the hottest setups and emerging leadership names as the market develops, helping you stay in sync with the institutions and ahead of the next big move.